Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Mark, happy Friday. Welcome to Digital Currents. How are you doing?
Doing great. Happy Friday. I appreciate you got a little Carolina blue for the Tar Heels playing lacrosse this afternoon. My blue is a little off, but I do have the Notre Dame belt on. I got a little flash of maize for you.
Excellent.
My Irish, we find out if they're ready for the national championship. They got to avenge their loss to Virginia later this afternoon in the ACC lacrosse tournament. So quick reveal, I decided to go green today for green candles. And I have the whale sock game. You know, could have gone with a lot of things. I mean, look, green candles, because we had our first green candle, monthly candle in a long time. So happy May Day, everybody. Recording this on Friday, May Day. April up 12+%. So big, strong month, and up 3% on the day, over 78K. Maybe in everyone's celebrating the big event in Vegas this week. So I went out to Vegas for Bitcoin 2026, and the whales were out. There's huge demand, institutional demand. Michael Saylor's stretch program, STRC, big push on digital credit. Converting that digital asset Bitcoin into digital equity and digital credit with MSTR and STRC. I think that's going to be a very big deal and a big driver of demand. So much going on in the Bitcoin world, but again, pales in comparison to what's going on in the AI world. We can slip in a little stuff, some excitement in the chip world. And, the other thing is, data, it's everywhere. I mean, everywhere you go, everything you do now is being driven by your digital footprint and what you liked or didn't like. And although I do like the one feature on X, oh my God, I call it X, Twitter. I do like the one feature on Twitter now. Oh, he got me to call it X.
Yeah.
I do like the one feature on Twitter now where you can limit what the algorithm sends you. You can say, I don't want to see any politics. I don't want to see any this or that. Interestingly, the number one thing that is muted is crypto. So not Bitcoin broadly, but crypto generally. I think that people are tired of the XRP nonsense and the crypto scam nonsense. But they're probably somewhat tired of Bitcoin talk too. But that inverse sentiment is a good thing, right? What everyone's piling into. I mean, levered long memory companies, levered long AI companies, the data center. And look, they all blew out earnings. Now there's a dirty little secret in there about accelerated depreciation and marking up their circular investments in each other. So everyone, quote unquote, invested in Anthropic, which is going up because they all promised to buy stuff from each other. And so they're all marking that position up in advance of the IPO. So that's a lot of the earnings. But look, they were blowout earnings and stocks are up a lot, and much to talk about at some point.
No, yeah, there's so much to get into. And thanks for setting the table, Mark, because I find myself, maybe it's because it's May 1st, and I just find myself so enthusiastic. I think maybe I'm finally out of the kind of the winter blues and doldrums, already thinking about Mother's Day and the gifts that I'm going to be doing. I've got a great one. Spoiler alert, Mom, I'm making you a garden. It's going to be awesome, and you're going to love it. And it's going to be deer-proof and groundhog-proof. So that aside on the groundhog piece, now, I saw this thing, Mark, right before I'm going to sleep, which is the worst time when you should be on your phone. I'm guilty of it as you are, but it's a bad habit. And speaking about from a quant trader's perspective, why are markets up when they should be down, right? And so there's so many reasons and juxtapositions for why that is the case, but I found his kind of logic somewhat intriguing in that markets are up instead of down because people keep thinking they should be down, and therefore they cannot time the market. And I thought that was kind of an interesting nugget for us to kind of noodle on here, because as we looked at Monday, right, BTC was close to 80K, right? It was 79,488, the 12-week high. Then it dipped on Tuesday. We're kind of now back a little bit towards Friday. And this was after the Fed Reserve's latest, announcement, no announcement, with Jerome doing a boomerang, kind of staying within the hen house, although, not exactly inside of it, maybe just kind of on the periphery. So it's interesting here that, with the war, with no kind of real clear end in sight, there's kind of this new normal. And also, as you've mentioned here, the rates have been kind of held at their current levels of 3.5, 375 back in December. Bitcoin responded and then dipped, if you recall, at that point to 75K, recovered. And so, when are the cuts going to be? Well, it's unclear.
Come on. It is astonishing, actually.
Mm-hmm.
I mean, that it's nothing short of astonishing that if you started in January and said the following things were going to happen, but the market's going to rip to new all-time highs, you would have laughed at people. Because so you had the Fed that was supposed to have cut 2 times already, has cut 0, and now has basically said not cutting. And maybe Warsh will come in and change things. Yeah. But Jerome was like, hell to the no cuts for you. So no cuts, so no easing of liquidity. Second thing, war. So, it's going to be over in 5 days. No.
Yeah.
Oh, mission accomplished. We had the mission accomplished moment. No. So now the blockade. So now we're blockading their blockade. And the president said now it's indefinite. I'm like, well, we have no jurisdiction over those waters. What the heck is going on? So if you would have said that we were going to take a police state move in the Middle East, you would have said, well, that's probably a tinderbox. That's probably bad. So all of this geopolitical mess, I mean, literally missiles still flying and bombs exploding and ships sinking and oil and inflation popping. I mean, oil prices over $100. You would have just said, oh my God, it's going to be a disaster. It's going to be a crater. And instead, we got one of the great short squeezes of all time. We got semiconductor stocks in the longest advance ever, now make up over 40% of the tech indices. And the concentration in tech broadly now exceeds 2,000. So every measure of valuation, of concentration, of lack of breadth of the markets, all of it looks like a bubble top. Mm-hmm. But to your point, because everybody's negative, that, market climbs the wall of worry. And the one thing, though, that is real, and it's mostly China, but not just China, global liquidity. So yes, the US didn't cut rates, but pretty much everyone else in the world did. And China not only cut rates, but they're printing money like it's going out of style because they are trying to become the world reserve currency. So you have global liquidity making new all-time highs. Liquidity drives markets. Okay, so that makes some sense. You've also got a coordinated intervention, shall we say, in Japan, Bank of Japan. And look, this new prime minister, she is a puppet completely. Controlled, I don't know exactly by who, but a total puppet. She came out of nowhere, installed. She's doing everything completely the opposite of Abenomics and that economy. Interest rates are spiking. none of it makes sense. And yet the stock market made new all-time highs in Japan until a couple weeks ago, or I should say until this week. So there's a lot of stuff that doesn't add up. But geez, all we have to do is have faith in AI, and it's
Right.
good.
We can have faith also, Mark, like our friend over at the Hilton, CEO of the Hilton. I'm sure you saw this, Mark. Our economy has a new letter. We are moving away from the K and we are flattening it out into the C-shaped economy. Mark, this is very promissory if I have ever seen something, because we've spent a lot of time speaking about the real realities, the economic underpinnings of why 90% of stocks are owned by 10% of the U.S. population.
Wait a minute.
And
he said the K is flattening into a sideways T. It's like
into a C with the idea is that you're going to have this consumer demand converging. So it's basically now broadening from high earnings to lower income.
Wait a minute. A K, okay, a K. A C would mean we have a top and a bottom. So basically the people at the bottom are going to zero. They're going to lose everything, and the people at the top are going to have everything. I would agree with that, right? If he said
that sounds more logical.
The bottom is coming up to the middle, there's no evidence of that. Zero.
So, I'm glad you picked up on that, because I wanted you to go there, because his argument is that basically the middle and lower income consumers are going to gain financial traction. And what he's basically citing is that, growth in his hotels, in particular in the kind of like low to mid-tier hotels, he's signaling growth in that area, and therefore it could extend to the broader economy.
Because people got kicked out of their house, and they got to have a roof over their head, so they're staying in budget hotels. Exactly. I mean, that is propaganda of the highest level. I mean, it good. Anywhere you go, any data you look at, layoff numbers are accelerating, and that is not the rich people, right? The rich people are not getting laid off. It is the middle class. And now the one thing, the one thing I will say, yes, his budget hotels are full at near the job sites of where they're building the AI data centers. That is true, right? There are a lot of people who are now having to drive, literally because there's a shortage of construction workers, drive to these remote locations where they're building these giant data centers. I just drove by one on my way up to get my haircut the other day. My barber retired, but it's so cool. He lives up, and so it means I'm getting super old, but he retired, and he's a little younger than me, but he built a little mini barbershop in one of those barns on his property up here in North Carolina. And so, but on the way there is this giant data center going in, and it is pretty active. Lots of pickup trucks. You're right. The hotels on that strip are doing well. So I will give him that maybe a swath of people in the thing the AI can't build, which is itself. So in the construction. So I'll give him that.
What about this, Mark? There are so many awesome nuggets that you put in there that I want to try to extract before we kind of get into some more meat and potatoes is, well, as we're thinking about, where we stood in January, all the change that we have almost 6 months later here into May, and yet, we're still seeing some strong economic signals from those that can benefit from those sense signals. But what about OPEC? Can we take a second to figure out that this may no longer be a thing? So the UAE has now announced it will no longer be a member starting today. And it's, figuring out on its long-term vision and economic strategy, and it could impact the group's ability to supply oil. Obviously, this is a big deal. There, as for listeners who know, there's basically quotas that have been set for a long time. They basically buoy prices. So by the UAE leaving that, not that they have nearly as much oil as Saudi or some of the others, but now, the expectation is they can ratchet up their supply, not dramatically and not overnight, certainly, but they are free to do so in a way that they have not been before. And of course, this Mark, if you would have said that OPEC being decimated would somehow create some
Hey,
economic positivity. I mean, oh,
cartels are generally bad, right? Just,
yeah,
price fixing is generally bad. Free markets are generally better. And so people leaving the cartel and, you know, entering the free market in theory should be really good for oil. I think one of the big challenges is, how the US in really a miraculous turnaround has gone from not a really meaningful force in oil production to the global leader. Like, we produce
yeah,
now, I think, coming up on as much as OPEC as a whole. And so when you take some of the member states out now, definitely more than OPEC, more than Saudi, more than Russia. So I think Saudi plus Russia might still be higher than the US, maybe, but
well,
Saudi has collapsed. And so
that's
I
like the Live Golf Tournament, Mark, but also backed by Saudis. I'm sure that you saw that. They have announced they are no longer supporting the Live Golf
I
Tournament
know.
to
Well, that
challenge.
was just such a disaster. I mean, nobody was
Yeah,
watching. And look, it's kind of like, it turns out, if you overpay for things, it doesn't work out, right? So,
right.
they overpaid for soccer or football clubs, and that didn't work out. And now they overpaid for golf stars, and turns out some other people were better players. And people don't just care about who was good; they like who is good. There's a nice kid.
Mhm.
There's a kid, like, UNC guy. Was number 6 in the world. I think Ben Griffin is his name. I think. Pretty amazing golfer. So I think all of that is interesting in how things are shifting. Maybe that's why we've got the blockade going, because we're trying to limit the amount of oil that gets into what I don't really understand, but why we consider China our adversary. I think they're more our collaborator and our partner, since we buy a lot of stuff from them and they buy a lot of stuff from us. It doesn't really make sense to antagonize them. But at the end of the day, it all comes down to chips and their desire to be dominant in the chip space. And the one thing that no one's talking about, there's a huge set of chemicals that come out of the Middle East, not just oil, but things like helium and other chemicals that get screened out of the crude when it gets distilled or refined. And I don't remember the exact certain chemicals, but there's a bunch of them that go to Asia, to Japan, to a bunch of old sleepy companies that did things like textiles and other things, but they happen to process these certain chemicals in a way that's necessary for Taiwan to manufacture semiconductors. And so if you look at some of these companies in Japan, they look like these sleepy little companies, but they're just rocket ship stocks, because people realize, oh my God, but they're now complaining that they can't get their raw materials. And so they can't produce these materials for semiconductors. And if semiconductor production slows, that throws a wrench in, the parabolic moves we've seen.
Yeah, Mark, there's one story that I wanted to get in before we totally move away from crypto and as crypto related to the broader markets. Speaking of things ripping, awesome. Speaking of things ripping was 21 shares. So here we saw a potential merger, or at least an intention to. It's not yet final. My idea, Mark, is that basically Tether merging the company with Strike and Electron Energy, which would be an aim to create this vertically integrated public Bitcoin platform. So then you'd have treasury, you'd have mining, financial services, obviously from Jack, lending and capital markets. If this goes through, this would greatly expand 21's original Bitcoin treasury strategy. And it made me think also of you, Mark, because obviously you're sitting on the board of some treasury companies. We speak about this a lot. These were a hot investment idea about a year ago. It since has cooled with the rest of the market.
Yep.
And the idea, like anything, I remember old trusty Bruce Greenwald over at 116th Street in Columbia. And he basically mentioned when The cost of capital is equal amongst firms, unless there are barriers to entry or otherwise moats. The profits will revert to the cost of capital. What does that mean? It basically means that if you can't innovate or you can't bring new things to the table, you're not going to be making any money.
No,
and so
100%. And no, it's such an important point. And I noticed you're wearing the Columbia blue today. I just realized that. Not just Carolina blue, it's Columbia blue too.
Great.
But what's interesting about that is, the idea of buying an asset and putting it in a public company, that has some value. I mean, closed-end funds have existed for a long time. Part of the problem with closed-end funds is they tend to trade at a discount because people will short the components and go long the actual asset and push the price. I mean, they'll go short the asset and long the components, and they'll push the price down. So the DATs had that problem, right? In the sense that people just said, all right, I'll just short your stock and I'll buy Bitcoin and I'll just arbitrage that spread. And the only defense was, as you said, to do something more, right? To become a operating company. And a couple ways to do it. One is what MicroStrategy did. Michael Saylor said, all right, I'm going to create the perfect digital capital stack. I'm going to create the digital economy capital structure so you can buy equity, you can buy bonds, you can buy converts, you can buy preferreds. And he did that. And things were going great, but then people said, well, I can short your equity and go long Bitcoin, and I can do some convert arbitrage with your bonds. So Wall Street fought back, as they are prone to do. They like to make money. Firms like Jane Street, which is all over everyone's feed, they're pretty good at scalping the participants in the market. And so we think it's kind of a free market, but there's got a toll to these people. I jumped. There's a trading company up in Chicago, and I met with him one time, and I'm talking to the guy, and it was funny. It was me and one of the principals and his Chinese PhD researcher and his Indian PhD researcher, who, when they spoke, I didn't really understand, not from their accent, but just because they were so smart. Like the things they were talking about, I was trying to keep up, and I finally just turned to my buddy and I said, Dan, what's the point? Like, he said, well, we use these guys' models and we never go to bed with a position on, right? We take a position in the morning, we take it off in the afternoon, we go to cash, go to sleep. So we never have to worry about what happens overnight. And we're basically trying to make 1%. And I'm like 1% what? Like a week, a month? He says, no, every day. I'm like, shut up. He says, no, every day.
Real.
Every day. I mean, think about that. And there aren't that many firms that can do that, but that's what these guys do. And it's by scalp. But so what 21 Shares is doing, they're trying to not copy. Imitation is the sincerest form of flattery. And, my strategy was first. And then Nakamoto, and a board member of Nakamoto, said, okay, we're going to do this. And they've started, right? They merged in BTC Inc. and their asset management company, UTXO. That's been going great, real cash flows. So if you can have a cash flowing business, you can be better than just a closed-end fund. What 21 Shares is adding to the mix, they're saying, well, we want to be able to produce Bitcoin too. So they folded in a miner. Now the mining companies have kind of been a version of DATs too. I mean, usually they have to sell the Bitcoin to pay their electricity costs, but occasionally some of them have kept the Bitcoin, and for a while they were rising up. In fact, I think still Mara might be the number 2. So I think it's Strategy's number 1, Mara's number 2, Metaplanet number 3. Was a board member there, just rotated off in March. My term was up. And then I think 21 might be number 4. And so the idea of mining as a piece of it is good. And then, Strike, which was Jack's original company, has pivoted from being a money transfer app kind of like Cash App, where you could send money anywhere in the world using the Bitcoin blockchain to a lender. And the advantage they have now is Tether is a pretty big, serious financial services company, and now one of the biggest, and one of the biggest buyers of treasuries. And so they have a lot of liquidity. And so they're providing a line of credit into Strike to make Bitcoin-backed loans. So there is a flywheel effect that could happen. Now, execution is the game. I mean, one of the things about all of these is the bulk of them, other than strategy, and Metaplanet. I mean, Simon's not as young as the other guys. Most of these other DATs are young people. And there's nothing against young people just because I'm old. It's not ageism. I'm just saying they don't have as much operating experience as someone who's just been around. And so I think, Pomp's another one. He's got his DAT, and he's trying to build a financial service company, and he rolled in the AI. So I think it's all good, and I think they're great visionaries. They're incredible visionaries. But I think that the challenge of public companies is it really rewards the great operators, the great capital allocators. So I think that's what has to be inculcated in these companies for them to be super successful.
No, absolutely, Mark. Well said. And we're seeing this kind of multiplicity strategy occur, not just with Jack and others, but we're seeing this also across the spectrum. So we saw that Morgan Stanley announced it's launching a Genius Act compliant government money market fund. That's a mouthful. I think they need an acronym there. But then also the Western Union, Genius Act compliant government money market fund, designed for stablecoin issuers. And then, of course, in a move that everybody saw coming, Western Union has now also given its indication that as early as next month, it'll roll out its own Solana-based stablecoin. But what will the rates be on that stablecoin? It's still going to be, Western Union-esque, or I'm sure it's not going to be as cheap as some of the portfolio companies that we have here, Mark. But it was a level one.
The stablecoin itself, again, should be pretty low cost to transfer money. But my question is, okay, why would you go to Western Union to pay them a fee? Yeah. Now, it probably won't be 16% like they've been charging. Maybe it's 12 or 10 or 8. I don't know what they're going to charge. But why would you do that instead of just downloading the Phantom wallet and sending your Solana? Now, I get it that bank to digital to bank is still de rigueur, right? That's what people have, right? If you're sending remittances home, you're a Philippine worker on a cruise ship and you want to send money back to your parents, you'd like it to be in pesos, no matter if you're getting paid in dollars or yen or euros or whatever. I don't know what they pay in international waters these days, maybe Swiss francs. But
yuan?
Yeah, maybe the renminbi or maybe even the ruble. I don't know. It depends where the ship is. But
that's right.
I get that, what Strike built, which is you could take money out of your bank account, instantly convert it to BTC, convert it back, and it goes out. That functionality is real. And Cash App, this is interesting. So the guy from Cash App, Jack Dorsey's company, Block, now went from Block or from Square to Block to now it's called XYZ. It's like, wow. It's like, pick a name. It's like JD Vance. Like, just pick a name. Come on. So, but he was up saying, now Cash App anywhere in the world, you can convert dollars to Bitcoin for no fee, no spread. I'm like, okay, but someone's going to pay the spread. So are you going to eat that spread to gain the assets on your app? Is it kind of like a Starbucks card thing where people, download real money onto their Starbucks card so they can post it on the internet? Like, but you're paying interest on that. So, okay. And there's a float, and why don't you keep that? And because the thing is, you can fill it in real time. Like when you buy the coffee, you can fill it with your credit card and then not have them have the money. But there was this kid from Beverly Hills, like, I have $14,000 on my Starbucks card. I'm like, you're just an idiot. I shouldn't. That's too harsh. That's too harsh.
It's a lot of coffee. That's a lot of coffee. No, we'll say more. I couldn't get off this point because it tied in so well. That's something that we were speaking about before in a little bit of fun when we were talking about the Hilton story and how, at the end, AI, is kind of limited in some of its physical infrastructure developments. And we'll say that SoftBank is trying to take the other side of this, Mark, because you saw the bet that they just made, right? They made it $100 billion IPO driven bet about this automatic data center construction company using autonomous systems to accelerate infrastructure build outs for what? AI. So robots building more AI in a company called Rose AI. And so, Mark, now it's starting to get a little bit scared because I thought the hotels would be safe, the actual physical dwellings, but now this is very much like a T2 moment, Terminator 2 Judgment Day. That's what I remember well.
Yeah.
When basically you just see the fields of robots creating other robots and factories. And that's really what Madasan is trying to bank on here. It's going to continue growing into the US. And it's a broader industry push, right? Because tech-enabled AI, industrial automation, Bezos has done stuff like this with Prometheus. We joked about that a couple of weeks back. And then basically, there's some skepticism. Obviously, SoftBank has had a mixed track record with some of their experimental bets. Mark, are we all doomed, or is there some hope here that this is a little overblown?
I mean, look, I'm personally going to take the under on this. That I really don't believe AGI is right around the corner. I really don't believe these models are sentient. I really don't believe that these things are anything more than tools, and they're only as good as the hand which makes them work, right? It's like computer. My 8th grade computer teacher, way back 100 years ago said it best, this computer's as smart as a screwdriver. It just is. And now everybody's like, no. Now the AIs are smart. I'm like, well, they're good and fast. I mean, they're good at reading, they're good at summarizing, they're good at it. But the idea that a machine, an AI machine tool, is going to design a building, and then like the machine itself can't build the building, so it's got to schedule, because there are no machines today to build the buildings. I mean, there's the one that builds it's like the big tube of cement in a square, and you can make a kind of looks like a house, 3D printed, but there's like 5 of those machines. There's not enough to build an AI data center. And the precision just isn't there. Like, we don't have the sci-fi movie drones that are going to come fly in and do the micro welding and do the interconnects with the precision of that needs human beings. Robots can't do it. So we don't have it. Now, maybe we will get it, and maybe you can't get it if you don't start trying, shoot for the stars, and maybe if you hit the moon, which we didn't hit the moon, but okay, whatever. That's okay. One last thing. This is funny. So I read that a big part of, Elon's $1 trillion comp package that everybody's all bummed out about, and people tried to vote against, but, Ron Barron voted for it, and so he got it. So, I mean, it wasn't just Ron, but so a big chunk of it is tied, I love this, to not just establishing a colony on Mars, but getting 1 million people. Like 1 million. So, and just by math, Elon, unless Brian Johnson gives Elon some special juice to make him live to be 200-ish, that's not happening. It's just
right.
not. So,
and Mark, we joked about this, right, on one of our calls yesterday, where it said, Mark, what say you for a timeshare? Are you interested, somewhat interested, not interested? Just like a weekend getaway in outer space.
Yeah, look, I mean, yeah, if, and I told you, if they can do the beam me up, Scotty, like teleportation, right. I mean, then maybe, but I'm not going to sit in a suspended animation for a year and a half. No, I'm just not doing that. I don't have enough days, right? And but we're not going to do teleportation. It's not going to happen. And I said, I joke, I wouldn't do it, right? Would you let them like decombust you and then put you back together? No.
Mark, it's not the decombust part I'm worried about. It's the putting back together part that I'm most afraid of.
There's a great movie about that. There's a great movie about that. I can't remember the name of it, but it was something like Split or something like that. And what it was, when they put it back together, it was like off a little bit. So like you had a glitch in your body and your organs didn't line up and people were dying. And there's a gazillion blood vessels. I just don't think they're going to put them back exactly the same way.
Yeah, but there's very little margin for error there, Mark. And on that note of margin for error, Anthropic, they're getting close here. Mark your calendar, Mark. In 2 weeks, they are trying to do this penultimate fundraise here, $50 billion that could close within 2 weeks to try to race toward that $900 billion valuation in that IPO mega round. This is what we've been waiting for. This is what the economy supposedly wants. This is what investors want. And this is aimed at financing enormous compute needs. It's got revenue already past the 30 to 40 billion mark in Anthropic. And, this is going to be it, right? This is what we're all waiting for. This could make or break the entire economy, Mark. What say you?
I'm sad. Like I'm legitimately sad. I mean, I'm sad for the people who are going to participate in this round because they're going to lose a lot of money. Because they won't be allowed to sell at the IPO, right? They will have to be locked up for 6 months. Who I am most sad for are all the average people. Back to that, there's no way we're going to see this is going to exaggerate the case. This is worse. And I just don't, well, I do understand because that's what people at the top like to do. They like to take wealth from the people at the bottom. I mean,
yeah. And I think, it's one of those things too, Mark, where some of the early investors are staying away from this round, choosing to potentially, like you mentioned, try and liquidate. But this would more than double the prior valuation, which was, wait for it, $380 billion. It would also surpass OpenAI's recent valuation, which was what? $852 billion. So they would be kind of sitting at the top of this. And this also off of the heels of Musk finally acknowledging the theft that XAI did in using their models to be trained by OpenAI. So not only are we having this circular revenue recognition, which we spent weeks talking about this, about how, you have a dollar going into the right pocket and then coming out of the left pocket. The right pocket is named Microsoft. The left pocket is named You Pick It, various companies. But now the technology, the models themselves. So if you figure out how can these companies stand to be differentiated, at least after the 6 months, because I think there will be some flurry because, they'll probably limited supply, like what we see with some of these IPOs, unless there's some sort of exogenous shock. Maybe it doesn't even survive the first week of being listed as a publicly traded company in terms of being in the black.
Well, and my big thing is, okay, I'm not a jobs doomer. I mean, there are people who say, well, no, when the AIs come and they're building all our data centers and they're going to lay off all the humans, so no one's going to have jobs. Well, so who's going to pay for Claude if they aren't working, right? I mean, I find the whole thing, like I say, the circularity of it is crazy, but this idea that an economy that's 72% consumption can somehow be made better by suddenly doing a bunch of construction, which is the antithesis of consumption. I don't know. I guess there is a path to make it all work out, but I really don't see it. And I think it's worse than that. I think it's super sinister. I think the purpose of these data centers is not a good thing, right? These are digital prisons in the end, right? If suddenly everything in your life has to be permissioned, and they create a digital twin of you that they can control through access to information, like maybe you don't get what you want from Twitter, maybe you only get what they give you, and maybe you can't use your credit card at the store because you drunk tested about the president. I junk tweet about the president. I just think there's definitely a bad place that this could all be going. And, I've gone down this, like, it's just weird to me that, the guy at the top is named Alt Man, right? That's like the antithesis of human. So.
Well, we'll just keep getting more sinister then, and we'll just kind of lean into that feeling where, probably for the last story on the 725 billion AI boom is hitting a hidden wall: connectivity, not compute, right? So this is an idea that this surge in 725 billion in 2026 capex from the hyperscalers, right? So your Amazons and Microsoft, Alphabet, Meta, they're basically now in this AI bottleneck. Not talking about GPUs. NVIDIA is obviously the big fish over there, but it's really towards this idea of this underlying connectivity infrastructure, allowing these clusters to kind of work together as a unified system. And so what's happening is there's limitations in networking from memory sharing, and data transfer speeds are becoming the true constraint. And then that's kind of elevated these other players that people have kind of forgotten about, like the Astera Labs. Mark, you mentioned Broadcom a couple of weeks back. They're suddenly becoming very, very important because they're helping build this connectivity tissue inside the data center. So really kind of the question is, will you have this compute drive this phase of the AI boom, or will the next, wave of value really be this return from these IPOs that we're kind of questioning the value getting built? What say you, Mark, in this kind of like potential bottleneck that could threaten to blow everything up yet again?
Look, I mean, we know that there are, back to I'm a chemistry and biology guy. So, back to the rate limiting factor, we know that HBM, high bandwidth memory, is the rate limiting factor in making GPUs work. And the ratio is shifting. You need more HBM per GPU to make it work. And that is just going to continue. And that's why companies like Hynix and Samsung, Samsung could as early as next year, but it's probably the following year, 28, will be the most profitable company in the world. Like, that's a big statement, right? And so and then you got the interconnects and going to photons, and the photonic stocks are going crazy. So I get it that they are building these data centers. And that creates a boomlet, but to price them at 50, 60, 70 times sales for commodities, these are commodities, right? Compute is a commodity. It's like electricity or anything else. And what happens to the price of commodities when people build excess supply? They fall. So I don't see how you're going to get the same level of growth. And let's just take the models, right? Oh, well, they'll just be able to increase the price of the models because people want to use them. Well, but other people are releasing better models for free. Like, I download a Kimi model that's better than the latest ChatGPT model for free. And I can run it locally. So I don't have to give out all my data to the data overlords. So I'm struggling with the growth multiples on commodity stuff. I get it for the people that supply the pieces, the components to build the boom. Sure. But again, we've seen that before. All the optical companies in 99, 2000 went vertical and then they went straight down. And Cisco went straight up and then it went straight down. And so we will reach a point at which we've overbuilt. And I still come back. My personal opinion is throwing more GPUs at the problem isn't going to make it better, because people are going to create TPUs and VPUs and LPUs and all these other things that are coming for innovation. And what the innovator does is it doesn't attack the people down at the bottom, it attacks the people at the top. So there are these waves of creation and disaggregation. And I think, extrapolating the top to the moon doesn't work. Never happened.
Yeah, I was trying to get this in a visual, which we'll probably have to follow up in another episode. But there was a kind of an important release on Wednesday, right? So we had those earnings reports of a bunch of these top companies. Amazon was chasing Microsoft, and Google had their big blowout, right? So for one of the since I believe the first time that they have now broken out the cloud portion of their revenue, since they've been doing that, they've had their best quarter ever, and they basically blew out the expectations, not just by a little bit, but a lot of it, right? So the forecast was 18 billion. They went up to 20 billion and saw this revenue grow, a massive amount since they broke this out in 2020. But they're not alone, Mark, because we're seeing the rest of these companies also have some pretty big results here, but their infrastructure market and their investments are massive. So in some ways, the market is kind of baking in this expectation that they just need to spend more to be able to just build bigger and better things.
But here's the problem, Max. Mm-hmm. It's the circularity.
Exactly.
So OpenAI, if someone pays them, I don't pay them, so I canceled my account. So if you pay them $1 and type in some, random question to their chatbot, it then spends $3.58 on average, not for every query, but on average, $3.58 at places like Google and Amazon for their computers. So yes, their revenue looks really good. But we just vaporized $2.58. And so the free cash flow of OpenAI is infinitely bad and projected to continue to go up to hundreds, plural, of billions of dollars. So why is their valuation going up if their free cash flow is going down?
Yeah.
Well, because we can raise money at increasing valuations because we promise. And who are they? I get it. Yes, there's no question Google had more revenue from OpenAI and Anthropic, but it was only because they could raise money to make the payments. That's a Ponzi scheme. Right? That's not business. That's a Ponzi scheme.
Right. It was $129 billion that Google spent in infrastructure in the quarter. And again, 20 billion was the return on that, which is still pretty good.
But wait a minute. If they spent 129 billion, isn't that supposed to be an expense? Oh, but they don't have to actually charge it against the revenues because they get to accelerate depreciation. But those machines are still there. You can't take the debris. It's like revenue recognition rules for, I signed the contract, so I'm taking all the revenue. Like, no, that's not the way it works. You get the revenue over time. But we have these silly, and then, stock-based compensation somehow becomes revenue in our funky accounting world. I'm pretty sure that's an expense in what I was taught in accounting. And so the funky accounting, the difference from GAAP is the high thing. I'm pretty sure that's right. It's the highest it's ever been. Like
Wow.
non-GAAP adjustments are the highest they've ever been. That's usually, I mean, every other time in history, has been the sign that things are going to come to an end, because someone eventually says, but you don't have any money. And if you look at the free cash flow of those big hyperscalers, they're gone negative. And the only way they can survive is to borrow money. Well, but who's lending negative free cash flow companies money? The same people. It's always the same group of people passing the same $1 trillion around a big circle, but then counting it multiple times. It's the same money. Well, it's actually not even money. It's just ones and zeros on a computer.
Right. It's tokens, kind of like this troubling stat, which could be good or bad, depending upon if you were extra sinister on Saturday or if you're more of a benevolent Saturday. So AWS reported that kind of this core spending on Bedrock services for building AI agents and apps, it jumped 170% from the fourth quarter, eating up more tokens in this quarter than in all of its history dating back to 2023, right? So this is some pretty uncharted territory, but then again, they increased the revenue 28% in the infrastructure area, 37.6 billion, which is almost $1 billion higher than the estimate. So it's one of those things, Mark, where it's like you have all these investment banks covering these stocks. They're very well reported. Yeah. And so if I know kind of what the grades will be to the test, and I know that I have to kind of spoof up my model in terms of spending a little bit more, well, then that's going to make my earnings and that's going to make my stock price look fantastic if I can take on this zero cost debt or close to zero cost when I account for amortization, right? So it exactly is what you said, Mark. You pulled me in with you into the deep dark side of Sinister Saturday. And,
well, look, I mean, at the end of the day, touch wood, life is pretty good. We have the ability to broadcast in HD. We have the ability to exchange instantaneous information. We have the ability to ask questions of this, all-knowing model, except that it hallucinates and still makes mistakes. But look, I love the fact that I can ask a question about something that I don't know, and that these tools can read lots and lots of stuff and give me a summary. That's very useful. I'm not paying anything for it yet. So that's the part I'm struggling with, is I'm literally paying zero because I don't use any paid models or paid services. I just use the free ones. And so someone's paying for all those tokens, but it's not me. And I appreciate whoever it is. And I have a bad feeling, though, that it is a false accounting derived nirvana. Again, we did it in 2000. We did it in the late 70s. We did it in the 50s. We did it in the 20s. And I'm not saying it's 1929 and that the world's going to end. I don't think it is. But I do think, we should be cautious and at least skeptical of kind of show me the money. Like where's Jerry Maguire when we need him?
Exactly.
Well, actually, it wasn't Jerry. It was his.
It's Cuba Gooding Jr. Yeah, that's right. That's right. He was the talent. He was the talent. Jerry,
show me the money.
Excellent. We'll probably look to cut it there. And I think as we kind of close into the week, a lot of interesting stuff as we kind of shift into what might be the summer months. Now it's getting a little bit warmer, and there's always no shortage of interesting news that happens, which we'll be covering with our audience every single week. We just want to thank everybody for tuning in wherever you are podcasting and watching from. And we want to remind our listeners, as always, to stay current.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.